on that topic today. Tax expenditures are becoming a critical issue in the negotiations over the debt ceiling. Democrats, and Mr. President, I ask unanimous consent that I be permitted to finish my remarks.
Without objection.
Thank you. Democrats say that they want to eliminate them. They refer to them as loopholes or spending through tax code. This might be a good political argument, but it bears little relationship to the understanding of tax expenditures in tax law or tax policy. Yesterday, I outlined a general definition of tax expenditures. They are most definitely not spending through the tax code, as President Obama so creatively put it. And they are most definitely not, by and large, loopholes. Rather, they were intentionally included in the tax code by Congress in order to realize certain policy goals. What tax expenditures are is an opportunity for families and businesses to keep more of their income. Unfortunately, rather than have a serious conversation about tax expenditures and tax policy, President Obama and his liberal allies are intent on setting new ground for juvenile public discourse. Faced with a $14.3 trillion debt going up every day, Social Security and Medicare programs that are set for bankruptcy, ruining American seniors, and legitimate fiscal crisis that poses a clear and present danger to the nation's security and the security of America's families and businesses, President Obama is again talking about shared sacrifice. Well, I like the term. The only thing is I would prefer to have shared prosperity. Because all we're going to get out of this administration is shared sacrifice, which means everybody's going to suffer. I'd like to have shared prosperity where everybody is lifted. The first time we really started hearing about this concept of shared sacrifice was in the debate over Obamacare. For those who are unfamiliar with Washington speak, this is what the president meant by shared sacrifice. Quote, I am going to raise taxes on families and businesses by over $500 billion, and I am going to do it by shaking down businesses, unquote. He made them an offer they couldn't refuse. Pay up now or pay up more later. So when we started hearing again about shared sacrifice, we knew what was coming. More proposals for tax increases. But I have to say I remain shocked at how ham-fisted most of these proposals are. They really are nothing but a series of bad talking points that can be used for the president's re-election campaign. These talking points were tired by the end of the 1936 presidential election. I would not be surprised to see President Obama dust off Franklin Roosevelt's speeches and start railing against economic royalists by the end of the debt limit negotiations. Sadly, the Senate's leadership has followed suit. After making a big to-do about keeping the Senate in session to address the fiscal crisis, we are spending this week debating a non-binding resolution demanding higher taxes on millionaires. Really? The Democrats' solution to $14.3 trillion in debt is to attack corporate jets. Seriously? $3 billion over 10 years? Last time they did that, they wound up with their tails between their legs in 1990, and then 1993 had to reverse the whole thing because it cost thousands of jobs. I never underestimate liberals' lack of respect for the intelligence of the American people, but this is a new low. Do they really think that ordinary Americans are so consumed with class hatred that they will respond like Pavlovian dogs to the criticism of corporate jets and forget that it was programmatic liberalism, not bonus depreciation of corporate jets, of tax benefits for energy companies, that got us into this debt crisis? And this is really how the left perceives Republicans. They want to score some cheap points against Republicans by going after corporate jets, as though all Republicans love corporate jets. I'd venture to say that an awful lot of corporate jets are owned by very wealthy Democrats. What are we going to get next week? A tax on monocles and top hats? Maybe we will spend next week debating a non-binding resolution on the need to tax Madras blazers for the good of the country. Unfortunately, not all of the Democrat proposals are a laughing matter. They've been down this road in the past, pushing tax increases on luxury items like yachts. Today, the press ridiculed Republicans for, quote, defending the yachting class, unquote. There is no yachting class in this country unless you count the Democratic Party of Martha's Vineyard. But there is a class of people who build yachts. This is what happened to those people the last time the Democrats engaged in class warfare of this kind. In the 1990 budget deal, a new luxury excise tax was created applying to yachts, aircraft, jewelry, and furs. first applying to the 1991 year. The similarities are eerie. Faced with soaring deficits, Democrats insisted that revenues be part of the equation. And how did this work out? The tax was repealed in 1993 because, as the Democratic-controlled Senate Finance Committee report, as reported by the Budget Committee, explains, quote, during the recent recession, the boat, aircraft, jewelry, and fur industries have suffered job losses and increased unemployment. The committee believes that it is appropriate to eliminate the burden these taxes impose on the interests of fostering economic recovery in those and related industries, unquote. Republicans are not defending the yachting class. They are defending the people whose jobs will be lost to Democratic class warfare. Of course, the left cannot contain themselves to these targeted tax increases. Just today, we read in the paper that the president is eager to reform Social Security. Yet it appears that he's only willing to do so if we let the 2001 and 2003 tax cuts expire. Tax cuts which only last December, the president acknowledged were necessary components of our economic recovery. And I would not be surprised to see the old Democratic hobby horse, an increase in the Social Security tax max, make an appearance in the Democrats' list of demands. These are non-starters, and everyone understands why. These broad-based tax increases would be a weight around our economic recovery. But the issue of tax expenditures continues to cause confusion and must be addressed. Those who advocate limiting or eliminating these tax expenditures suggest that they are spending and loopholes that benefit wealthy individuals. Yesterday, I offered a grown-up definition of what a tax expenditure is. Today, I would like to highlight which are, in fact, the top tax expenditures. What we will find is that the tax expenditures that would generate the largest amount of revenue are also those that are available to the middle class, enabling them to give their churches and synagogues, and to save for a home, for college, and for retirement. To really get at meaningful deficit reduction, Democrats would have to eliminate these expenditures. Is that really what they want to do? That might be a good question at the president's next press conference. Maybe someone could give him a copy of this chart right here that we're going to put up and ask which of these tax expenditures he's willing to eliminate in the interest of deficit reduction. Number one, the exclusion for employer-provided health care. Is he going to want to get rid of that? That's 13% of all tax expenditures. How about home mortgage interest deduction? Is he going to get rid of that? How about preferential, that's 9%. How about preferential rates for dividends and capital gains? That's 8%. Exclusion of Medicare benefits? They're going to do away with that? Well, that's 7%. Net exclusion of defined benefit pension contributions and earnings? Are they going to attack our pensions? That's 6%. An earned income tax credit? My gosh, that's 5%. Deduction for state and local taxes, except real property? That's 5%. Number 8, net exclusion of defined contribution slash earnings. That's 4%. How about number 9, exclusion of capital gains at death? 4%. And how about number 10, deductions for charitable contributions? That's 4%. I venture to say hardly any American's going to want to do away with all those in the interest of getting more revenue so the Democrats can spend it back here. Well, look at that chart. It's a list of the top 10 tax expenditures. You know, maybe someone could give him a copy of this chart and ask which of these tax expenditures he's willing to eliminate in the interest of deficit reduction. I encourage all my friends to look at this chart. It is a list of the top 10 tax expenditures. With the rhetoric coming out of the White House, you might be surprised to learn the tax benefits for yachts and corporate jets are not in the top 2. Not only do they not make the top 10, they don't even come close. If you take the so-called savings that would come from the corporate jet tax approach of the president, it would take us 3,000 years to even reach the approximately $800 billion stimulus package. In the context of the president's $1 trillion deficits, They are statistical noise. So what are the big tax expenditures? Well, number one is an issue from the Obamacare debate. It is the exclusion for employer-provided health insurance. The exclusion of employer-provided health insurance from income is the single largest tax expenditure, representing 13% of tax expenditures. Yesterday, a member of the other side's leadership pointed out that the largest tax expenditure is one for corporations. Boy, is he wrong. Here's what I said, and I quote, "The biggest single deduction is the employer's exclusion for health care premiums. So employers are able to exclude from income the amount of money they spend for health insurance for their employees. That's the biggest," unquote. Well, that's just an incorrect description of law that they're arguing. Employers always have been allowed and should be allowed a deduction for the cost of benefits it provides to its employees. Employee compensation, including the provision of health insurance to one's employees, is the cost of doing business, and thus properly deductible by the employer so as to accurately measure the income or profit of the employer. That has never been considered a tax expenditure. The exclusion at issue, which is a tax expenditure, refers to the employee's tax treatment, not to the employer's tax treatment. That is, most compensation that an employee receives from his employer is includable as taxable income. One of the few exceptions to that general rule is that employees do not include in taxable income the value of employer-provided health insurance. Coming in at number two is the home mortgage interest deduction. Now, this expenditure alone accounts for 9% of all tax expenditures. The third largest, there we have the lower rate on capital gains and dividends. Do away with this expenditure and the rate on capital gains and dividends will almost triple in about 18 months. Capital gains and dividends represent 8% of all tax expenditures. What's number four? Here we have an untaxed piece of Medicare benefits. Imagine that, Mr. President. I wonder how many folks on the other side realize this, or even if the President does. When my friends on the other side categorically talk about cutting back tax expenditures as the yellow brick road to deficit reduction, I wonder if they know that hiding behind the curtain is an increase in the after-tax cost of Medicare. Do my friends on the other side realize this? A few months ago, a liberal group ran an ad showing my friend, the chairman of the House Budget Committee, Paul Ryan, pushing an old woman in a wheelchair over a cliff. His crime? Recommending policy changes that would prevent the inevitable bankruptcy of Medicare. I'm not going to hold my breath waiting for this same group to pull the fire alarm because the Democrats' talk of eliminating tax expenditures might result in seniors getting hit with higher taxes on Medicare benefits. But this is what the President and the Democrats are talking about. If they are serious about using tax expenditures to reduce the deficit, these are the things that will have to be on the table. These are the big expenditures. This expenditure is real. You can look it up in the handy tax expenditure publication from the Nonpartisan Joint Committee on Taxation. And it is significant, representing 7% of all tax expenditures, the exclusion of Medicare benefits. At number 5 is the pre-tax treatment for defined benefit pension plan contributions and the inside buildup on the accounts. This is a tax benefit that reduces the cost of those workers who make the decision to save for retirement. This represents 6% of all tax expenditures. What's number 6? It is the refundable earned income tax credit, the EIC. When folks describe tax expenditures as spending through the tax code, this is one that could properly be labeled that way. Under congressional budget rules, this one, for the most part, scores as spending. That's not the case with the other tax expenditures on this list. Refundable tax credits score as spending because the government cuts a check to the taxpayer. With the other tax benefits on this list, the taxpayer is receiving a portion of the money back in the form of reduced taxes. Now, there's some serious tax hikes there. This tax expenditure accounts for 5% of tax expenditures. Number 7 is the deduction for state and local taxes. My friends on the other side need to be particularly careful with this one So far, they would hit seniors, families that have health insurance through their employers, people with mortgages, and anyone who owns stocks and bonds. But with this, many Democrats risk alienating every last taxpayer in their states. Removing this deduction is going to hit high-tax states hard. If you're from a so-called blue state, it is likely that constituents are already heavily burdened with state and local taxes. Take away this and you will, in effect, drive up the marginal rate of your constituents who take their deduction by as much as 35%. I am convinced that many of the inroads Democrats made between 2006 and 2008 were due to carefully crafted Trojan horse campaigns. Skillful operatives ran Democratic campaigns promising moderate tax and spending policies that would be respectful of families and businesses. But once that Trojan horse got inside the Capitol, and former Speaker Pelosi and President Obama took charge, frustrated liberals spilled out and started taxing anything that could move to pay for the largest expansion of government since Lyndon Johnson was in office. Removing the deduction for state and local taxes might be the final act that restores purple America to its traditional red hue. At 5% of all tax expenditures, this would represent a massive tax increase, this net exclusion of defined benefit pension contributions / earnings. I guess that's number 7, the deduction from state and local taxes, except for real property. What's number 8? This is the pre-tax treatment for the contributions workers make to their defined contribution plans and the inside buildup on the accounts. Many of us know of these retirement plans as 401k plans. At 4% of tax expenditures, this is a significant incentive to families to save for retirement. Number 9 is a bit more obscure, but no less critical for families. It is the tax expenditure for the step-up in basis at death. We all know the saying that nothing is as certain as death and taxes. Well, if this tax expenditure were eliminated, this step-up in basis at death, this saying would take on an even darker meaning. Death could now be taxed twice. First, the decedent's estate might get hit with the death tax. Then the decedent's heirs would be subject to tax again on the gain embedded in any inherited asset, should they decide to sell it. This accounts for 4% of tax expenditures. We close with number 10, the tax expenditure that is probably the most important one to my constituents in Utah. It is the tax benefit for donations to charities other than education and healthcare institutions. When you make your weekly or yearly donation to your church, you can now deduct it for tax purposes. This charitable deduction represents 4% of all tax expenditures. And the folks in my state all pay tithing, almost all of them. That's 10% of their gross income. I do it every year. And I got to tell you, you'd hit a lot of really charitable people and a lot of churches with the loss of that one, number 10, and yet that's the smallest of the whole 10. As the chart shows, these widespread everyday tax policies account for almost 2/3 of tax expenditures. We're not talking about yachts or corporate jets. Now, I've already suggested that rolling back many of these expenditures would have an immediate adverse impact on American families and taxpayers. They would also undercut long-standing federal policies promoting saving, home ownership, and charitable giving. Let's turn first to retirement security. About half of Americans save for retirement. The overwhelming bipartisan consensus is that this number is way too low. Ideally, all American workers would be saving or should be saving for retirement. More savings means less financial stress on Social Security and Medicare. Most importantly, it means retirees can enjoy their retirement if they can rely on a nest egg. That's why there has been a bipartisan desire to incentivize retirement savings through worker participation in retirement plans. A time-honored method has been to offer a tax benefit up front in the case of traditional defined benefit of the traditional defined benefit plan, traditional defined contribution, or traditional IRA. The benefit remains untaxed during the individual's working years. It is only taxed when received in retirement. By contrast, Roth pension plans and IRAs provide a tax benefit on the back end when a worker retires and begins drawing on the account. Former Finance Committee Chairman William Roth captured the policy rationale best by noting the deliberate tax policy bias towards savings. Chairman Roth used to make the point with a rhetorical question. He'd ask, quote, "Is there any bad saving?" Unquote. Of course, the answer is no. One thing we know for sure, curtail or eliminate the tax expenditure for retirement savings, and the after-tax cost of savings will rise. Savers will react. It is true that some will continue to save, but it is also true that they will have less to save if they choose to do so. For middle-income taxpayers, it will probably mean lower savings rates. Is that a good policy to put in place? Consider this. According to the Joint Committee on Taxation for 2009, over half of households paid no income tax. 49% of Americans shouldered 100% of the income tax burden. The half shouldering the income tax burden are also, generally speaking, the part of the population making sound personal decisions, like saving for retirement. That behavior is good in both a micro and macro sense. In the micro sense, workers are sacrificing current consumption for security and a better standard of living in the future. On a macro sense, the collective behavior of these citizens stabilizes our aging society. To encourage this kind of sacrifice, our tax policy provides a tangible tax benefit. Take away that tax benefit and, as with raising taxes on anything else, you will get less of the behavior. Take away the tax benefit and you will get less saving for retirement. Mr. President, does that make any sense? In order to avoid restraining the rapid growth in government spending, our friends on the other side would have us send the wrong policy signal to half of our population that saves. They would add to the burden of those who are already shouldering the entire burden of funding the federal government. At the same time, by discouraging saving and personal responsibility, we would further unleash the appetite of those who want to spend more. Take another look at the chart. Add up the tax expenditures from defined benefit plans and defined contribution plans. They account for 10% of tax expenditures. Over 5 years, the revenue from these expenditures amounts to almost $700 billion, with a B, billion dollars. On a per-year average basis, it is $140 billion in incentives for growing government spending. Do we want a society where more saving is encouraged? Or do we want a society where dependency and more government spending are encouraged? Do we want to look more like Switzerland? Or do we want to look more like Greece? The answer to this question is clear to the citizens of this country. Unfortunately, not all of their representatives seem to have thought through the implications of going after tax expenditures. To get at this from another angle, I would like to discuss the impact on taxpayers of cutting back some of these tax expenditures that come in the form of itemized deductions. I'm going to examine the effects of cutting back these itemized deductions by applying President Obama's budget proposal to cap itemized deductions at 28%. It is clear that some in the White House are pushing this 28% cap hard in the negotiations over the debt limit. As noted before, itemized deductions generally are considered tax expenditures. But itemized deductions impact a number of basic, long-standing features of American life. Itemized deductions include the home mortgage interest deduction, the charitable contribution deduction, and the state and local tax deduction. The President is proposing to chisel away at these itemized deductions, and we should carefully reflect on what that would really mean. President Obama has proposed repeatedly, quote, to limit the tax rate at which high-income taxpayers can take itemized deductions to 28%, unquote. It appears that this proposal is designed to lessen the benefit to higher-income taxpayers of itemized deductions. The Joint Committee on Taxation says that this provision would mean the federal government would collect an additional $293 billion in taxes over 10 years. True to form, this is just another version of the same soak-the-rich play that the left has been running for decades. From their perspective, it is unfair that higher-income individuals get a more valuable tax benefit than lower-income individuals. But this perspective mischaracterizes the critical issue. The 35% bracket was established by Congress with an understanding that itemized deductions would allow a significant tax benefit. Had Congress known that higher income taxpayers would be disallowed some of their itemized deductions, as the President now proposes, undoubtedly Congress would have set that bracket at lower than 35%. So taking away some of the benefit of itemized deductions for higher income taxpayers while leaving the higher income tax rates at their current levels upsets the balance struck by prior Congresses. Obviously, Congress is allowed to do this, but let's not pretend that these expenditures are loopholes or oversights by prior Congresses. The President and the Senate's Democratic leadership are free to do this if they choose, but they should at least come clean about what they are doing. They are significantly raising taxes on the people who are already shouldering the lion's share of the federal income tax burden, 98% of it, as a matter of fact. Even aside from the staggering character of this tax increase, one that would clearly violate President Obama's campaign pledge not to raise taxes on the middle-class Americans, the macroeconomic impact of this cap is negative at best. President Obama's 28% cap would reduce the benefit from the home mortgage interest deduction. For 5 years now, our nation has been experiencing a bursting of the real estate bubble. Current headlines indicate that this trend will continue for a time. Limiting the value of the home mortgage interest deduction would apply additional downward pressure on home prices, not only for high-end homes, but for all homes. By repeatedly proposing to limit the benefit of the home mortgage interest deduction, is it the President's intent to further depress housing prices, or is this mere collateral damage from his desire to raise taxes? But the damage from this cap does not stop at the housing market. President Obama's 28% cap would also reduce the benefit from the charitable contribution deduction. This would almost surely reduce the amount of contributions people make to churches, synagogues, temples, soup kitchens, shelters, universities, and museums, just to mention a few. Is that the President's intention? Does the President know that these revenues might never materialize because the elimination of this deduction will step up pressure for direct government assistance for the poor, for students, and for the arts? Finally, this cap would reduce the benefit of the state and local tax deduction. I touched on this point earlier. High-tax states are able to soften the blow of their high taxes by pointing out to their citizens the federal deductibility of such taxes. So my colleagues from high-tax states might want to talk to their governors about the impact the President's proposed cap would have on state and local public finance. Mr. President, I want to be clear about something. Our tax code is a colossal, awful mess. And tax expenditures must be a part of any conversation about tax reform. But I want to emphasize that the conversation about tax expenditures should happen in a conversation about broad-based tax reform. Reform that flattens the code while lowering rates. The conversation about tax expenditures should be a sober one in the context of a meaningful discussion about tax policy. Unfortunately, the President has chosen instead to target tax expenditures willy-nilly with little regard for the policy implications of these tax hikes. And make no mistake, whatever the President wants to call it, reducing spending through the tax code, closing loopholes, or making people pay their fair share, these are tax increases, plain and simple. And they are tax increases on the middle class. There has been some criticism in recent days about Republicans for their commitment to a pledge many of them took against any tax increase. I have to admit I'm at a loss here. Conservative Republicans, convinced that taxes are already high enough, promise their tax-paying citizens that they will never support a net tax increase. They gave their constituents their word, and they're sticking to it. Meanwhile, President Obama, who promised not to raise taxes on the middle class when running for office, vows to break his promise at every opportunity. And yet it is the conservative Republicans who are somehow lacking integrity? Hardly. Mr. President, I don't care how many blows I take from sophisticated Washingtonians and professional leftists for sticking by my pledge to the people of Utah. I will resist any effort by the President to include tax increases as part of the deal to increase the debt ceiling. I will do so for a number of reasons. First, Our tax code needs a fundamental overhaul. It is a complicated mess that is lacking in fundamental fairness. Yet the President's proposal to reduce tax expenditures for deficit reduction is a proposal to maintain a tax code that grows more burdensome by the day. The President's proposal essentially robs the government of the revenues that it might use later to flatten the tax code and lower rates. More importantly, I oppose the President's proposed tax hikes as a matter of principle. Flattening the tax base without any offsetting rate reduction is a tax increase. My friend, the ranking member on the Senate Budget Committee, Senator Sessions, captured the point well in an interview the other day. I'll quote Senator Sessions. We have to be honest and recognize that if you're going to eliminate systematically a host of deductions and keep the money or spend it on new programs, then you've raised taxes. It just is, unless we've changed the English language, unquote. The campaign against tax expenditures is a campaign for a tax increase. It is a tax increase that could send the wrong signal to those Americans who sacrifice current consumption and save for retirement. It could raise the bar for those Americans who want to experience the American dream of home ownership. It would mean the residents of high-tax states would face even higher state and local taxes. And it could mean a cutback back in the volume of charitable giving. This is shared sacrifice that the nation cannot afford. I preferred shared prosperity by cutting taxes and giving these small businesses and businesses the opportunity to use that money to hire people and get people working and get more people paying taxes. And I think it's abysmal that the bottom 51% do not pay income taxes, and 23 million of them get refundable tax credits from the government that are far more than the payroll taxes that they might have to pay, which are Social Security payments. Is he going to come back? Mr. President, I listened to my colleague from Vermont saying that we cannot do anything on Social Security, you can't do this, we can't do that, the poor people are going to be hurt. Where are they going to be when Social Security is bankrupt? Where are they going to be when Medicaid and Medicare are bankrupt? The way we're going, that's where they're going to be. We can't keep spending like this, and we've got to quit playing the phony game with tax expenditures. All I can say is that we have got to get with it around here. And we've got to start working together as Democrats and Republicans in the best interest of the American people, and that is reforming this awful tax code, getting taxes down for everybody, and taking care of the poor, but also expecting everybody to have some skin in the game, except the really poor, and help our country to pull out of the mess that we're in. Mr. President, I suggest the absence of a quorum.
Clerk will call the roll.
Mr. Akaka.